London, 9:02 a.m. The trading floor locks up. UK bond yields explode through 5.7%, levels unseen since the 1990s. Dealers stop mid-sentence. Screens drown in red. The pound collapses. Gold doesn't rise, it erupts, smashing into history. And then, like smoke in the room, a whisper turns into a roar. An IMF bailout, not for some fragile emerging market, but for Britain, a G7 power. And this is only the beginning. Because across the Atlantic, the United States sits on $9.2 trillion of debt that must be rolled over this year, refinanced at the exact same brutal rates now ripping Britain apart. If the UK's implosion is the overture, America's treasuries aren't just exposed, they're already standing at the edge of the cliff. The UK's Debt Management Office unleashes a record $14 billion in long-term bonds. Demand looks monstrous, $140 billion in orders, but the mask slips fast. Investors will buy, but only at crisis-level yields. The illusion of safety shatters. The message is savage. Britain must bleed. It must pay multiples more today for the same money it borrowed cheaply just a handful of years ago. This is the arithmetic of collapse, the mathematics of lost faith. The shock spreads like fire. France's 30-year yield spiked to 4.5%, the steepest in more than a decade. Germany, the fortress of Europe, sees long bonds at 3.4%, a peak that signals even its safe harbor is under siege. Sovereign debt, once unbreakable, now cracks like thin glass. The market demands higher returns from every government, everywhere. No exceptions. No mercy. Debt is no longer forgiven, it is punished. Gold detonates through $3,500 an ounce, the highest in history. And in a brutal twist, the US dollar grows stronger, feeding off the chaos, pulling in desperate capital despite Washington's own debt inferno. Investors don't trust anything, but still they run toward the few symbols that look unbroken. What looks like diversification is nothing but panic, dressed up as strategy. Behind this storm is a deeper truth. The OECD shows the numbers with chilling clarity. Public debt in advanced economies surged from 70% of GDP in 2007 to 110% in 2023. 2 decades of crises, rescues, promises, and political cowardice left governments drowning in liabilities. And now the bond market has taken the whip from their hands. Politicians won't discipline themselves, so investors will. The vigilantes are back. Yields are the punishment. In Washington, the unthinkable happens. The 30-year Treasury slams through 5%. For a moment it drifts back, but the line is broken. The world's deepest market has been pierced. Traders mutter about weak US jobs as an excuse, but everyone knows. The wound is structural. The Fed can cut short-term rates, but the long end doesn't listen. It answers only to supply and inflation, and both are merciless. The gap between central bank control and market reality is a chasm that grows wider every single week. For Britain, the math is catastrophic. Debt to GDP sits at 100%. The nation owes as much as it produces. Unlike the United States, it doesn't issue the world's reserve currency. It cannot command buyers. Every single pound of borrowing must be begged, bargained, persuaded. And now a $28 billion budget black hole yawns open. Chancellor Rachel Reeves faces a nightmare choice. Raise taxes on an economy already choking, or slash spending before an election year. Markets don't believe she can do either. Already 8% of the $1.3 trillion budget is eaten alive by interest payments. Double the pre-pandemic burden. Interest alone devours nearly 4% of GDP. Growth in 2024? A pitiful 1.1%. The imbalance is grotesque, debt service rising 4 times faster than the economy itself. Every notch higher in yields strangles the private sector. Companies suffocate under borrowing costs. Families watch mortgage bills skyrocket. Public debt cannibalizes private investment. The IMF's warning lands like a blade. Without real reform, Britain could face external rescue. 10 years ago, that idea was laughable. Today, traders talk about it as inevitable. And the currency, sterling, falls, and with it comes imported pain. Every decline makes energy more expensive, food more expensive, goods more expensive. Inflation feeds on the slide. Whispers rise that the Bank of England might intervene, might buy bonds to cap yields. But that is a trap. That is money printing. That is quantitative easing reborn. Gasoline poured onto the fire of inflation at the exact moment households are already buckling under the squeeze. Britain is caught. No exits. Borrowing costs exploding. Growth suffocating. The pound unraveling. A government cornered by numbers it can no longer bend. The bond market has spoken, and it does not forgive. The pound sinks further. Bond markets rebel, and the shadow of unchecked monetary easing completes a dangerous triangle of fear. Options markets reflect the same anxiety as speculators rush to stack bets against sterling, convinced that every policy blunder will unleash another round of depreciation. The air is thick with unease. Meanwhile, Britain's fragile ties with Washington fray once more. A sweeping 10% tariff on exports slashes earnings, striking at industries already suffocated by mounting borrowing costs. Factories shutter, jobs vanish, tax revenues collapse, and the nation's fiscal math deteriorates. Each lever the government pulls only widens another gap, trapping policymakers in an inescapable bind. In the middle of this unraveling comes a revelation that reshapes the storyline. Bloomberg reports that ultra-long sovereign bonds, once considered the fortress of safe investing, have delivered negative returns for the first time in decades. The shock ricochets across trading floors. This is no longer a uniquely British disaster. It is a sign of something larger, the erosion of a core assumption that government debt represents permanence, stability, and safety. If bonds are no longer trusted, what takes their place? And if investors retreat from long-dated maturities, how can nations finance obligations that extend across lifetimes? Pensions, healthcare, infrastructure, entire social contracts built on the faith of perpetual borrowing? The spotlight shifts to Washington. U.S. Treasuries, long seen as the world's ultimate haven, begin to show cracks. 30-year yields hover stubbornly near 5% despite faltering economic data. Worse, federal debt balloons at a breathtaking pace. In just 48 summer days, America's obligations swell by $1 trillion, averaging $31 billion daily, nearly $1 billion every hour. Bank of America analysts warn this surge rivals wartime spending, yet tax inflows can't keep pace. Tariffs are advertised as fiscal salvation, with $31 billion collected in August alone and $500 billion projected yearly. But economists at the Peterson Institute remind the world that this is no gift from abroad. The burden falls on American households and importers, quietly taxed through inflated prices. What Washington calls new revenue is, in practice, a hidden levy that fuels inflation and eats away at disposable income. Around the world, investors grow wary. Pension funds and insurers, once loyal buyers of ultra-long gilts and treasuries, pull back, unwilling to shoulder duration risk. Their retreat forces governments to rely more on short-term debt, multiplying refinancing needs and amplifying rollover risk. Every auction becomes a trial of confidence, and every failed trial drives borrowing costs higher, tightening the spiral further. Even the Federal Reserve, once a bastion of independence, faces turmoil as President Trump removes a governor. The move unnerves markets, hinting at politicized monetary policy. Traders worry that if central bank decisions are perceived as politically driven, confidence in treasuries as a neutral benchmark could fracture, shaking the very foundation of global finance. And the tremors spread outward. Yields climb together across advanced economies. In Japan, long bonds reach fresh highs as political turbulence undermines faith. In Germany and France, governments wrestle with swelling debt while populist backlash blocks austerity. What began in London now ripples through Tokyo, Berlin, and Paris. The illusion that advanced economies can borrow endlessly evaporates. Investors recall a paper presented at the Jackson Hole Symposium, which claimed U.S. debt could rise to 250% of GDP without lifting yields, if fiscal adjustments worth 10% of GDP were enacted. But the same paper warned that without such adjustments, markets themselves would enforce discipline through soaring yields and a sovereign debt crisis. To meet that condition, Washington would need to slash $2.7 trillion annually, an almost unthinkable political challenge. Few believe it feasible. Fragility is visible in the numbers. Since June 30th, global ultra-long bonds have lost over 2.5% in value, marking the worst quarter in memory. Investors who once enjoyed stable, predictable income now face sudden portfolio shocks. Insurers and pension funds, the pillars of long-term savings, confront existential questions if losses continue. The spiral sharpens the central dilemma. If gilts and treasuries can no longer be trusted, where does the world store its wealth? Gold soars in response, reclaiming its ancient role as a refuge. Yet gold cannot build roads, fund schools, or pay salaries. Bonds are not merely investments. They are collateral, benchmarks, anchors for the entire financial order. Remove that anchor and the global system drifts unmoored. By year's end, Washington must refinance $9.2 trillion. With yields already elevated, every auction risks driving costs higher. The more the U.S. borrows, the more investors demand in return, locking the nation in a feedback loop reminiscent of the UK's doom spiral, only magnified by the dollar's central role. Should 30-year yields surge to 6%, the shockwaves would cascade through mortgages, corporate borrowing, and global reserves. For now, the dollar endures, buoyed by its entrenched position in global trade and central bank reserves. But endurance is not immunity. If fiscal discipline stays absent while yields remain high, even the dollar's dominance may erode over time. Reserve managers are already diversifying into euros, yuan, and gold. The UK's bond implosion is not an isolated crack. It is a flare in the night sky. warning that the foundations of global debt markets are crumbling. Once, investors trusted advanced nations to borrow without end. Today, they demand higher returns, imposing a discipline many governments are unprepared to face. And then comes the statistic that reframes everything. Since January 2025, the combined market value of global sovereign bonds has fallen by more than $3 trillion, the steepest plunge in modern history. For the first time, the so-called risk-free asset itself generates systemic risk. The collapse of British gilts is not merely a national crisis. It is the prologue of a worldwide reckoning, whose next chapter may play out in Washington. We're glad you joined us. If this perspective helps you see the shifts reshaping our world, don't forget to like, subscribe, and explore the next video waiting for you now.